How's it going? I'm Jason. I'm your host. Welcome to the Week in YouTube Finance.
For the first time in history, Moody's has officially downgraded the United States credit rating from AAA down to AA1. This is not a drill. This is a major moment in financial history, and today I'm going to break down exactly what this means for your portfolio, your money, and the markets moving forward. Let's dive in. But before that, you're probably wondering, Marco, why are you wearing this outfit? It's because I want to support our struggling American companies overseas. How are these Vietnamese children gluing your Nike shoes together going to eat their bowl of ramen if we don't put them in these factories? Let's get into it. Okay, so this isn't the first time the U.S. has actually seen a downgrade. So back in 2011, S&P dropped our credit rating from AAA to AA+, and the markets didn't take that lightly. Before I show you that, I want to actually explain this chart right here. So the ratings agency is up here. You can see dark blue is Moody's, pink or purple is S&P, and then the aqua blue is Fitch. So you can see the first time in 2011, S&P dropped that right here. The second time was Fitch. That was in 2023. And then the third time, for the first time in history by Moody's, was just a couple days ago. So if we go into the aftermath, let's see what happened here. So after the 2011 drop, after S&P downgraded us, the S&P 500 fell nearly 8% in just 2 months. So the S&P 500 is the blue, the greenish line right here. I know it's kind of hard to tell, but you can see right after that, it just bounced right back. So I don't want this to sound alarmist. You can see the 10-year Treasury yield fell by 35%. That's the pinkish salmonish line. It did spike back up, but also started to keep falling pretty precipitously in the months after. And then if we fast forward to 2023, when Fitch downgraded us, you can see that they cited like ballooning debt, fiscal inaction, Fed rate hikes. I don't know if you guys remember this time. This was only about a year and a half ago, 2 years ago now. The S&P 500 dropped 10%. So the S&P 500 is this green line right here, but then again, it just bounced right back after a couple months. So what I'm trying to get at is you may see a dip for the next month or so, and then after that, up and to the right, baby. Dollar cost average, buy the dip. Don't be a coward. Okay, so if you look at this, the Russell also got smoked. It was down 17%, and unlike 2011, yields actually surged 23% instead of dropping. Again, that's only after the first couple months, and then they drop back again. So why the flip? Well, it's simple. So the concern has shifted from political gridlock to the actual sustainability of U.S. debt, which I've been talking about on this channel for many years now. Okay, so why is Moody's doing this now, even though we've seen Fitch and S&P downgrade us in the past? So they're citing that they project the federal deficit to hit 9% of GDP by 2035. This is up 6.4% this year. You can see this green line is basically just the federal total public debt. And then also debt to GDP ratios to spike to 134%, which we saw here. This is higher than even World War II levels. Even though we did come back down, it is starting to rise back again, and we are above 120% of debt to GDP. And the most alarming out of all this is that interest payments could consume 30% of federal revenue by 2035. So for context, that number is only 18% today, you guys. That's a 66% increase in just over a decade. But again, not to be alarmist, let's put this all into perspective. So this chart right here shows you all the credit rating scales by agency. And then here's Moody's, S&P, and Fitch. They all mean the same thing. The tiers mean the same thing, just the numbers or lettering may be a little bit different, the nomenclature. But if we look at Moody's, we basically went from AAA to AA1. So we went from prime to the highest tier of high-grade credit, okay? So again, I know this makes headlines, it makes everyone kind of scared, but you know, we're not even close to being, you know, lower medium grade or even upper medium grade, okay? You get into like junk bond territory or junk credit rating territory when you start to get into the double B plus and then the double B ones here. Also, check out this clip from Fundstrat's Tom Lee on CNBC. This is pretty important to put things into perspective. He thinks this is all priced in anyway.
I don't know if there's much signal in the downgrade Friday because I think the first AAA downgrade was signal from 2011. I don't think Moody's had any information that we didn't have on Friday afternoon. So I think markets should realize the bond market largely priced in the fact that the U.S. is really not AAA anymore. So I'd be viewing this as a buying opportunity.
That said, you're not discounting the notion that the vigilantes have been reawakened a bit?
You know, I think everyone should be aware the U.S. has an unsustainable path for debt, but I think the real signal will be when an auction fails. That happened a few years ago, and then we realized that was the time to really pay attention to the fact that we have debt sustainability issues. But I think a downgrade itself, I don't think it made this much signal.
Okay, so let's talk about the suspicious timing and the market reaction to all of this. So what makes this downgrade even stranger is the timing. So it was released at 4:45 p.m. on Friday, right after options expiration. So when most traders had already logged off for the day, I think that's a little highly unusual if you ask me. So the market reaction was obviously classic. We had yields popping, and they still are. 2-year, 10-year, 20-year, 30-year, they're all popping. Stocks are obviously dipping, and volatility is coming right back into the spotlight, which I've been talking about on this channel basically since Liberation Day, or actually in March, even before Liberation Day. So remember, deficit spending and the unwinding of the basis trade, they've already been pushing yields higher, and now it's like pouring gasoline on the fire. So if you look at this chart right here, this is the ultra-short Lehman 20-year Treasury. You can see the 10-year note yield spiking up, and then you can also see the S&P 500 spiking down. It's just proving that 10-year notes are going up, S&P 500 going down. Okay, so why does this matter for the long term? So some are saying, who cares? It's already priced in. People, they're still going to lend to the United States. You know, we still have basically the deepest capital markets in the world. And that is true for now, for sure. But I want to be very clear. If interest payments become unmanageable, if foreign investors start demanding higher yields, and if confidence in the U.S. debt erodes, that downgrade comes very fast. Okay, that becomes real. I'm not saying the Chinese yuan or renminbi or the Russian ruble or any of this stuff is going to be the next world reserve currency. I'm just saying until those other countries get their stuff together, whether it's BRICS, whether it's China, USA is still number one. Okay. Hence the Nike bucket hat, okay? Every time I play golf with this, I shoot scratch, okay? No, I'm kidding. I don't shoot scratch. So let's look at the political bigger picture. So this downgrade just came hours after Trump's budget bill was blocked. So if you guys have been following this, several Republicans calling for deeper spending cuts. So that budget, it would have added $2.5 trillion to the national debt. Or deficit, excuse me. And this isn't always like a left versus right issue. If you guys haven't picked up on that yet, I try and be as politically neutral as possible on this channel. I like to make fun of Trump. I like to praise Trump. And then I just end up pissing everyone off. But I don't care. It's fun for me. But again, this is just math, you guys. The U.S. spent 34% of its GDP on government spending last year. Okay, that's the highest ever outside of crisis period. So if you look at this chart, you can see World War II was 36%. Vietnam 32.6, Gulf War 34.6, Great Financial Crisis almost 37, COVID was 42, and we're at basically 34% today, higher than Vietnam War. Again, how are the Vietnamese kids that are gluing my shoes and this hat together gonna eat ramen? Oh wait, they don't eat ramen. I meant to say pho. Oh, why am I saying? I'm confusing my Asian culture. I apologize. Even though I do feel like I was Asian in a previous life, I do enjoy Asian cuisine. Not Midwestern Plaza Asian, General Tso's chicken. I'm talking like actual Asian cuisine. But anyway, shout out to all my Asian friends. You can see that Doge is trying to clean up some of this. I made videos about this in the past. I won't touch on this too much. But this is unemployment claims in Washington, D.C. They skyrocket in early 2025 because of all the Doge layoffs beginning in January. So we'll see what happens, you guys. I also want to share one last chart. I've been talking about gold a lot, obviously Bitcoin a lot. Take a look at the gold inflows chart right here. 1 second, let me pull this up. So this is gold. Investors are piling into gold funds. So they posted a record 85 billion in net inflows just year to date. You see that red spike right here. Gold is now the best performing major asset class, up 22% year to date. So since the October low in 2022, gold is actually up 97%. Okay, you basically doubled your money. So at the time of this recording, gold has outperformed the S&P 500 by over 22% year to date. And just to get a quick little sponsor in, I just happen to have to the outro of the video. Okay, so what does this actually mean for you? Let's get into my thoughts as always. So Moody's decision to downgrade the U.S. credit rating is not just some random academic headline. It's real. It could have real consequences, but as we've seen in this video, some people think it's already priced in, but you can see from this chart right here, bond prices immediately dropped, which pushed yields higher across the board. So this is the 10-year right here that I'm showing you. If we look at the 30-year, you can see that it's starting to spike up. Basically, since June of 2020, it hasn't stopped going up. So if you go to the past 5 years, you can see that it's up basically from 1.6 or 1.4%. We're now sitting at almost 5, okay? So here's why that matters. So Treasury yields directly influence the rates that you pay for on things like 30-year fixed rate mortgages, auto loans, even credit cards sometimes, even though they're becoming ridiculous with almost 30% APRs, but whatever. So if you're financing a house or buying a car or carrying a balance, your cost of borrowing just went up. And don't forget, all of this is unfolding at a time when the economy is already feeling strain from President Trump's escalating tariff policy. So between rising debt, rising rates, and rising geopolitical risk, it's safe to say that the pressure is building, okay? Again, I put my money where my mouth is. It's so weird. My last video, I talked about how the market's going back up ever since that trade deal, aka the 90-day tariff pause between China and the U.S. happened. And then there's a couple comments saying, Marco, what are you talking about? You've been negative lately. It's not. You can't just read the title of the video, dude. I just put in 50 grand in the market. I'm up tremendously. Okay, hold on. What was the sound effect that I used? Where's he at?
I'm gonna come.
Yeah, that's my portfolio.
I'm gonna come.
So. I'm just kidding. It's a PG rated channel. How can I be negative when I'm actually telling you what to do in the videos? I've tripled down on my VTI position. I've posted all the screenshots. All you have to do is watch the whole video. Don't just read the title. Don't be a little child that goes to the library and looks at, oh, I like this cover of this book, and then never reads the book, okay? Don't be a child, okay? So bottom line, pay attention to your debt, be cautious with new borrowing, and as always, stay diversified, stay disciplined. If you got value from this video, don't forget to smash, destroy. Gently click the like button, gently click subscribe, gently hit the bell for notifications, turn on notifications on your mobile device so you know when I actually post, and always share the video with 13,000 friends. Thank you so much. Have a prosperous This is how I'm going to be buried. Just with my Nike hat, Nike Air Maxes, and 2 gold coins, buddy. Viking send-off, or like a Roman emperor or something, you know?
Everyone says if you want to become wealthy, don't drink at Starbucks, don't rent where you live, and work to get a high-paying salary. But there are some very simple wealth killers that most people are overlooking that are holding so many people back from ever becoming wealthy. That's why in this video, I want to go over the 7 biggest wealth killers that I'm seeing right now in today's economy. And wealth killer number 1 is your car insurance. Over the last year plus, the place where we saw the highest inflation is not rent prices, it's not egg prices, it's car insurance. And the thing about insurance is that some insurance companies are going to charge you a whole lot more for the exact same coverage. I'm going to sound like a Geico commercial, but if you spend 15 minutes shopping around for car insurance, you can save 15% or more every single month. Wealth killer number 2 is not earning interest on your savings. Right now, the inflation rate has fallen, while interest rates are still high. According to the last inflation report, our current inflation rate is 2.3%. This doesn't mean that the prices of things have fallen or that we're going back to 2019 prices. It means that the prices of things today on average are growing by 2.3%, which means if you can grow your savings by more than this, you are becoming wealthier. And right now, interest rates are still high because the Federal Reserve Bank has not cut interest rates, which means if you put your money into a high-yield savings account today, you can earn somewhere between 4 to 4.5% in interest on your savings. These are FDIC insured banks. It's not a stock, it's not an investment, it's just a savings account that's paying you a higher rate of interest, which means you can actually get a return on your savings. This is a very different economy than a few years ago, because a few years ago we had inflation rates at, let's say, 5 to 9%, while savings accounts were paying you 2 to 4%. So take advantage of these higher interest rates. That way you can actually beat inflation. That being said, saving your money even at a high yield savings account is not going to make you wealthy. You have to invest your money, which brings me to wealth killer number 3, being an emotional investor. Let's do a little history lesson on the 2025 stock market, because in February, tariffs were announced, causing the stock market to crash. Then, one day later, when the tariffs were paused, we saw the stock market boom again. In March, the tariffs were reinstated, causing a global stock market sell-off. A few days later, tariffs were put on pause again, and the markets boomed again. In April, we saw Liberation Day, tariffs on countries from around the world causing a global stock market crash lasting about a week. And then those same tariffs were put on pause again, causing the stock market to boom. And now here we are today at the time of me recording this video, and the stock market is nearing new record highs. 2025 will go down in history as one of the most educational years in stock market history, because you can see the importance of not being an emotional investor. The investors that were able to put their emotions to the side were able to see these downturns as buying opportunities. People were able to buy the dip in February, buy the dip in March, buy the dip in April, and build wealth quickly, because if you want to buy good investments, might as well buy them when they're on sale. Now, I'm not saying we're not going to see volatility ahead. I'm not saying we're not going to see a market crash ahead. I'm not saying we're not going to see a recession ahead. What I'm saying is, if you want to be a long-term investor, downturns give you the opportunity to buy good investments at a discounted price, because most people in February, March, and April panicked, freaked out, sold, and lost money. But if you want to be able to build wealth, you have to be able to put the emotions aside, understand recessions happen. Number 2, understand market crashes happen, and that they will continue to happen. Now, for those of you that are investors or want to become investors, again, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the stock market, housing, crypto, and the global markets, including our own economy, into a fun, witty, and easy-to-read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning. Plus, when you join Market Briefs, you'll also get my investing masterclass, where I'll be going through how you can start being a smarter investor and find hidden investment opportunities in today's economy. So if you want to get this investing masterclass and Market Briefs all for free, all you have to do is click the link down in the description below. Wealth killer number 4 is living the pandemic lifestyle today. In 2021, my wife and I rented an Airbnb in downtown Chicago. It was a beautiful city, but the most interesting part about this was every luxury store in downtown Chicago would have a line around the block starting at 9 in the morning to get inside and buy Louis Vuitton, to buy the Gucci, to buy all these expensive branded stuff, because stimulus checks were going out, unemployment checks were going out, money was going out freely. People didn't have expenses because of the pandemic, and so people were spending money like crazy. Today, the economy is a little bit different, but some people haven't changed their spending habits. They're still spending today the way they were during the pandemic, and they don't have the money to do so. On top of that, the prices of things are a lot more expensive today because of inflation. On top of that, the free money is gone, and you have to pay your student loans again. And on top of that, credit card debt is breaking brand new record highs almost every single day. So yeah, we're no longer in the pandemic, but some people are still spending like they got the free money coming in. Wealth killer number 5 is sports betting. Back in the day, gambling meant flying out to Vegas so you can hit the slots. Today, all you have to do is pick up your phone and download DraftKings or FanDuel. More Americans are gambling than ever before, and the most shocking part about this all is more and more people don't consider sports betting gambling. They just call it gaming. Look, if you want to gamble, be my guest, but you got to remember rule number 1, which is the house always wins. If you're going to gamble, expect to lose money. Expect to not make any money, and do it for the fun if you find it fun, but you're not going to make any money. The house is designed to win, because if they were not going to win, they wouldn't be in business anymore and you wouldn't be able to gamble. Wealth killer number 6 is paying for conveniences you can't afford. Life has become very convenient that we can order whatever we want with the click of a button. It started with Amazon, then it was Uber and Lyft, and now it's getting your food and groceries delivered to you with DoorDash and Instacart. But there's a cost to that convenience, and a lot of people are paying for that cost who don't have the money to pay their bills. That means when you're DoorDashing or Uber Eatsing your Mickey D's, Now, not only are you paying for the McDonald's burger, but you gotta pay for the service fee, you gotta pay for the delivery fee, and then you gotta pay for the delivery tip on top of that. But that's not all. With buy now, pay later, you can get your McFlurry delivered to you and then pay it off in 4 easy installments of $3.24. I really don't know how to explain this one better, but if you're not balling out rich, you probably shouldn't be getting your McFlurries delivered to you. And wealth killer number 7 is not investing in yourself. The best investment you can make is not the S&P 500, it's not Nvidia, it's not Tesla, it's not real estate, it's not gold, it's not Bitcoin, it's you. And it's very easy to spend $1,000 or $500 on a trip or a fancy dinner or some fancy stuff because you feel like, oh yeah, I'm gonna have a lot of fun, so let's not worry about spending this $500. But when it comes to spending the same $500 on yourself, on your education, on your own knowledge, on your ability to be a smarter investor, to build your financial education, now we start to get very critical. Am I gonna get a good return on this? What happens if things go wrong? What happens if I don't get a return on my money? But when it comes to us spending money on that fund, we never question it. And this is where I want you to be a little bit more comfortable investing in yourself. Start with investing time into learning things on YouTube. Then read some books, buy books, read them, maybe audiobooks. Then maybe buy some classes or research if you are an investor. That way you can have better insights, better information to make smarter decisions. That way now you can invest in yourself to be able to build more wealth instead of just trying to do it all yourself, because sometimes you can learn from somebody or something else to shortcut your path by spending some money instead of having to do it all yourself. And there you have it, the 7 biggest wealth killers of today's economy. If you have $100 in your bank account and you want to buy this $1,000 Gucci scarf, your bank would love to lend you the $900 at 25% APR, because when you make the minimum monthly payments, your banker gets richer. But that's just the beginning. When it's time for you to buy a house, who do you ask? How big of a house should I buy? Many times it's your banker, and they're not your financial.
What's up, you guys? It's Graham here. So this is getting out of control. As of right now, the national debt is approaching $37 trillion. It's expected to increase by another $1 trillion every 3 months. And with interest payments recently hitting an all-time high, like it or not, there will be serious consequences for everybody watching if you aren't prepared for what's about to happen. For instance, in just the last week, we've seen investors literally selling America. Interest rates have been surging higher. Bitcoin hit an all-time highs. Investors left the dollar, and the entire financial system was recently downgraded, which is something we haven't seen since the great financial crisis. This is why we really have to talk about exactly what's happening, what this means for you, why the billionaire Ray Dalio says that the risks are greater than they appear, and then what you could realistically do about this to come out ahead profitable, especially since right now is the best time to make the most of it, or at least potentially save yourself a lot of money. Although before we start, if you appreciate videos like this and find them helpful, it would mean the world to me if you hit the like button or subscribed if you haven't done that already. I know I don't like asking for it either, it's annoying, but it does make a significant difference for the channel, and as a thank you for doing that, here's a picture of a hamster. So thanks so much, and also big thank you to Cookie Unity for sponsoring this video, but more on that later. Alright, now in terms of where we start, it all begins right here with the national debt. Think of this like, how much does a country have to constantly borrow to keep itself afloat? And as the billionaire Ray Dalio suggests, this number is growing more and more unsustainable by the day, leading to an outcome that he refers to as the changing world order. Now, I've mentioned this before in previous videos, but for those unfamiliar, throughout history, Ray Dalio explains that there's a repeatable cycle that happens when a country's spending grows to a point where there's no turning back. And he argues that the United States is already there. How? Well, the fact is, if a country can't sustain its own debts, it needs to choose between defaulting on its loans and printing more money. And it's always going to choose printing more money. That devalues its currency, raises inflation, and gives way for another currency or nation to take its place. Or I guess to explain it a bit further, according to him, the United States is entering a danger zone, with first, debt to GDP at 122%. This means that we are spending and borrowing more money than we're able to produce every single year. And as government interest rates continue to rise, it's recently hit a record high, now surpassing the amount that's being spent on national defense. Second, 3 forces are colliding at the exact same time. and that would be debt and monetary policy, internal conflict, and external conflict. In this case, he says that there's a huge amount of attention being justifiably paid to tariffs, while very little attention is being paid to the circumstances that caused them and the biggest disruptions that are likely still ahead. Third, there's also political division. In fact, according to polls, we are the most politically divided that we've ever been in history. For instance, throughout the United States, there are huge differences between someone's education, the amount of opportunity in front of them, the amount of money they make, and what they believe in. And when a government can't solve for these inequalities, both sides equally fight as hard to gain control, and that leads to less conviction throughout the rest of the world. That winds up with fourth world orders breaking down. As Ray Dalio believes, we've taken an America First approach rather than a multilateral cooperative world order, which would be the best for everybody to foster as much growth as possible. And this comes at the expense of our long-term goodwill. This is partly why we've seen some massive changes occur throughout our economy in the last few weeks that very few people are paying any attention to, like the United States credit downgrade. Look, for those unaware, since the United States largely functions and operates on borrowed money, they're issued a credit rating that demonstrates the likelihood of repaying back their loans, which in this case are issued in the form of treasuries. In fact, every single country has a rating like this, and for a long time, the United States was considered to be the safest because not only are they the reserve currency, but they also have a perfect track record of paying everyone back on time as agreed in full without any drama. However, on May 16th, the credit agency Moody's downgraded the US in terms of their future outlook, going from what's called a AAA rating to AA1, while signaling that their outlook had gone from stable to negative. Why? Well, they've pointed out that Congress has continuously failed to reduce the national debt and borrowing. Over the next decade, they expect larger deficits as entitlement spending raises while government revenue remains broadly flat. Large fiscal deficits will drive the government debt and interest rates higher, and future performance is likely to deteriorate relative to past performance. Essentially, the US debt is growing unsustainably fast, revenues are slowing down, interest rates are going higher, other countries are looking better in comparison, and they project that by 2035, interest payments will make up 30% of the total budget, which is insane. Like, imagine you, as a person, need $100,000 a year to survive, and $30,000 a year of that is just interest on the money that you owe. It's unsustainable. Now, even though the United States has never formally defaulted on their debt, and realistically probably never will, this does point to the fact that more than likely the United States will have to print more and more and more and more money. And if fewer investors buy that debt, interest rates will begin to rise like they have been for 5 main reasons. According to the Wall Street Journal, 1. More investors are jumping into the stock market rather than buying US debt, and that's causing interest rates to jump higher so as to entice people to buy them. 2. Investors are paranoid about rising prices, and if they believe interest rates will pay higher in the future, there's no reason to go and lock themselves in now. 3. People are worried about the country spending too much money, and they want to be compensated extra for that additional risk. 4. Other countries like Japan are paying more on their own bonds, which could reduce demand for US debt. And 5. There's the worry that tariffs could cause other countries to stop buying US treasuries, causing interest rates to go even higher, which is what started to happen. And this is where things get a bit crazy. Although before we go into that, I don't usually do this, but I had a sponsorship that was Thank you so much, and now let's get back to the video. Alright, now in terms of how this affects you, as Ray Dalio points out, a credit downgrade's not the entire picture. Instead, a bigger concern is devaluing the US dollar. See, here's the thing. In times of uncertainty, investors buy safe haven assets like United States treasuries because our government is seen as the most stable place to park extra money. Normally, the more investors buy in, the less these treasuries have to pay because there's such high demand. But this time, the opposite is happening. As the stock market's been going up, Treasury yields have been going even higher, suggesting that investors in countries are not buying US Treasuries anymore, and the United States is left holding the bag. In fact, the head foreign exchange researcher at Deutsche Bank previously said that the damage has been done. The market is reassessing the structural attractiveness of the dollar as the world's reserve currency and is undergoing a process of rapid de-dollarization. Shortly after this, the Federal Reserve stepped in to say that they're prepared to intervene in financial markets if liquidity issues arise, basically reassuring everybody that if things get too bad, they're going to step in with the money printer and bail out the economy. And in a way, this is what they've already been doing. As you could see, after injecting trillions of dollars into the markets throughout 2020, they're still continuing to buy mortgage-backed securities in US Treasuries, albeit at a slightly slower rate, suggesting that they're still supporting the markets to some degree. And this is especially evident when you see that they've been doing this since 2008. At the core, there's just no way to sugarcoat it. Our debt is growing at an unsustainable pace, more and more money continuously gets printed into the economy, and at some point, it just becomes unsustainable. Now sure, they could reduce government spending, increase tax revenues, and slowly begin paying it down, but the more time goes on, the more this appears to be unlikely, especially when you take a look at the tax cuts. As of right now, a new tax reform is in the works that aims to extend the 2017 Tax Cuts and Jobs Act, increase the state and local tax deduction from $10,000, eliminate taxes on tips, and reduce tax on overtime work, among a variety of other initiatives that I'll cover in a future video. Although in terms of paying for all these tax reductions, House Republicans are voting to increase the federal debt ceiling by $4 trillion. In fact, the Yale Budget Lab calculated that it would add $3.4 trillion to the cumulative deficit over the next decade if tax cuts expire in 2028 and 2029 as scheduled, or $5 trillion if they are extended. And another analysis found that over the next 10 years, another $9 trillion could be added to the national debt. On top of that, this is not a Democrat versus Republican issue either, because as you could see, over the last 80 years, both sides have operated at a loss, with the only exception being Bill Clinton, who raised revenues in part due to the dot-com bubble, but only by 2.3%. Of course, in terms of who owns this debt, 42% is held by private U.S. investors like Warren Buffett, 20% is held by government agencies, 13% is held by the Federal Reserve, and the other 25% is held by foreign buyers like Japan, the UK, and China, which is a number that's risen by fivefold over the last 50 years. This just means that realistically, government debt is going to become more and more difficult to sustain. Interest payments are already outpacing the amount being spent on defense and Medicare, and as the debt becomes more and more expensive to finance, the repercussions are going to be felt practically everywhere as interest rates have to increase to attract new money, and that of course will continue to devalue the dollar. For example, mortgage rates have just now risen back above 7%. The 30-year Treasury yield recently passed 5%, and this means borrowing money for most people is going to become a lot more expensive. Like, this is what Warren Buffett previously had to say on this. He says that if the government rate rises, the price of all other investments must adjust downward to a level that brings their expected rates of return into line. Consequently, every time the risk-free rate moves by 1 basis point or by 0.01%, the value of every investment in the country changes. Essentially, all this means that if people lose faith in the United States, interest rates are going to have to rise to compensate for that additional risk. Prices of other assets will likely begin to fall, and that means the more likely you are to be affected. So in terms of what I think of this and what you could realistically do about this to come out ahead, here's what you came for. In terms of the national debt, I'm going to be honest, I don't see it getting better anytime soon. The dollar's on an unsustainable path, government spending is out of control, and neither side wants to do anything about it. Is this something that's going to tank the economy overnight? No, but over the next few decades, it's something to keep in mind, because eventually it's going to have to get dealt with. Until then, though, just expect more money printing, more bailouts, and this can continue for a very long time. That's why for the average person who simply wants to make the most of what's in front of them, I'm a big fan of number 1, make sure you don't hold on to too much cash. Now, that's not to say you shouldn't have an emergency fund or some cash on the sidelines for something you're saving up for, but it is to say that you probably shouldn't stay out of the market for many years in a row. Otherwise, you're going to be losing purchasing power. Number 2, you should diversify your investments throughout as many different sectors as possible. The fact is, the more you spread out your money, the more you reduce volatility and risk. And this is the approach that I've taken. That way, should one market fall, the others should more than make up for it. For example, over the last 50 years, whenever inflation has increased past 5%, gold has provided an average annual real return of 10.35% during a time where stocks had negative returns. 3, you should also ignore the negative news and just keep buying in as usual. Study after study shows the best thing that you could do is simply to keep buying in the market no matter what the price is, don't panic sell, and hold. Not to mention, if you just miss out on the top 10 best days in the market in a 30-year period, you'll lower your returns by half. 4. Make sure you keep a steady income. I've said this before, but one of the biggest risks is simply losing a job at the time the market is down and we hit a recession. This is why it's so important to keep a consistent income, to be able to buy in these dips, or at least reduce your expenses so that you have some extra money to fall back on. 5. It's also probably better that you stay at a margin or leverage. I think it's pretty safe to say that you're playing with fire anytime you borrow money for the sake of investing. It's probably not a good idea unless you really know what you're doing or just have an appetite for a lot of risk. And finally, 6, if you need the money for a specific purpose over the next 2 to 5 years, it's probably a good idea not to invest all of it. The reality is, a few years is not a long enough time frame to ensure that you're actually going to make money in the markets. And as we've seen throughout history, there have sometimes been decades where the market has not recovered and you would have lost money in the short term. So the longer your time horizon is, the more likely you are to actually make a profit. Honestly, I don't think our current path is sustainable in terms of national debt and spending, but at least following this should give you the best chances of coming out ahead profitable in the long run. And of course, I'm open to hearing your comments as well, so feel free, let me know your thoughts down below, and I do my best to read and reply to as many of you as I can. So thanks so much, I really appreciate it. Make sure to like and subscribe if you haven't done that already. I really appreciate it, and until next time.
Well, thanks, everybody. So here I am. I made it to episode 20. This is supposed to be going to 100. That's the challenge. We'll see how far I make it with your help. How can you help? Subscribe. That at least tells the YouTubes, tell the algorithms, tell the gods and universes and everyone involved that I'm trying. I'm trying to do well. So back me up if you can. Thank you. Weird, right?